good evening, good afternoon, good morning. Welcome to our practitioner series. I'm Srinivas Kunte. I'll be moderating this session. Our topic for today is on big data and fund manager evaluation. Big data is the future, and evaluating fund managers is something that we have been doing all the time, again and again. But do we really understand how to evaluate a fund manager? Do we just look at performance, or there are other things to look at as well? Let us find out more. Our speaker for today is probably one of the best minds I have known, with expertise not just in AI and computing and machine learning, but in investment management as well. Sabeeh Ashhar is a director of quantitative research at Morningstar in India. He holds a degree in engineering and a master's in business administration. Sabi is working towards his CFA charter. I look forward to the day when he actually has his CFA charter and looking forward to having him in the community. He has more than 14 years of industry experience in core competencies in AI, machine learning, and quantitative research. You all must have probably looked at the FT article which said that Morningstar has started producing have been producing research in Morningstar. But here's Sabeeh Ashhar for you, who will delineate things, will make us understand how big data works and what it means in terms of fund evaluation. Now, just a few housekeeping instructions. The webinar is for about 60 minutes. We do go overboard sometimes, but it's 60 minutes, 45 minutes of presentation, last 15 to 20 minutes are for Q&A. But please don't wait for your questions. Put those questions on the chat box, not on the chat box, on the Q&A box. And the webinar presentation will be available for you. Harshad will be sharing the link as well. And last but not least, we really value your feedback. So please complete the evaluation survey before you sign off, and also write to us on the types of speakers you want, on the topics you would like to cover. Now, without further ado, I'll hand over the proceedings to Sabeeh. Sabeeh, over to you.
So thank you, Srinivas, for having me here. I'm really very excited to be part of this webinar and keen to share my learnings in terms of quantitative finance, specifically in areas of big data and fund manager evaluation. So hope that everyone is staying home and staying safe. It has been overall been a tough year for us, and hope that we are out of it sooner. So quickly moving on, the key learning outcomes that we want to have post this webinar is how could we use big data for fund manager evaluation, and specifically from the lens of factor models. So at a initial level, we will try to understand how the factor model is constructed, what is the methodology that is going behind the construction of these models. We will see also like the salient points around how these factor models or the outcomes from them can be used for understanding the sources of alphas for fund, the risk return attribution for funds in terms of these factors, and being able to understand like the manager skill to time these factors, and also how these funds would stand out in adverse market events. We would also in the end see like how we could scale up factor models by executing analytics at scale using big data and cloud technologies. Without so quickly starting out here, we try to cover what is the basic of a factor. So factors are credible success stories in the market, right? So they are like interpretable and distinguishable patterns that we see in the market, and they have added like a lot of value to the investors in terms of generating differentiated and excess returns. Now these patterns differ across various regions in the market. So suppose if I go to the North America market, I would see like a set of investors who would like to purchase stocks who have given like good past returns. Similarly, if I go to Japan, I would see like a reverse effect where people would be keen to, or the investors would be keen to buy stocks which are available at a cheaper price compared to their fair value. Also, like the emerging trend in the European region now is to buy stocks which are having good ESG attributes, specifically focused towards driving sustainable investing. In the current view, what we are seeing is the global returns or the impact of these factors in terms of generating returns. So as we can see, we have the traditional factors, the momentum factor, which is like the buying stocks which have got good past returns. We have like the valuation factor, we have got the value growth factor, we have the size factors. Now these factors are there for quite some time and have become like sort of primitive in nature. Now with the advent of big data and cloud technologies, we are having a lot of like new data points being available, the latest being like the ESG. So as you can see, like an ESG factor is contributing to like generating positive returns. And apart from that, using natural language processing, we can also generate a lot of factors from unstructured content like the corporate filings. We can generate factors from sentiment factors from like the news articles, etc. Now, there's a lot of like recognizable patterns in the market, and we can't generally say everything is a financially effective factor. To be classified as a factor, it should first be incisive, means that it should be able to differentiate returns on a scale. An example could be like there is a difference in returns in terms of like the highly volatile stocks versus low volatile stocks. It should be intuitive and it should have like recognizable patterns. So as we see in the market, like the small cap stocks are having like different returns compared to the large cap stocks. It should also be interesting in the sense like a lot of factors keep on evolving and it should be differentiated from all the earlier pre-discovered factors. At the same time, it should contribute to generating some sort of excess return while controlling for turnover. Now, there are various ways of testing out whether these factors are financially efficient. So nothing can supersede human intelligence, and a couple of techniques in terms of evaluating the financial efficacy is creating long-short portfolios, creating factor turnover analysis, doing information analysis, and factor alpha analysis. On the other hand, like we can also do a lot of statistical checks, like we can check the multicollinearity of the factor with other factors. We can do the persistence analysis of the factors. We can do condition value checks. And apart from that, we can put these factors in existing factor models and do a post analysis where we check like the R square of the models. We can check eventual outcomes or the factor stats like key stats, etc. Now, while we have talked a lot about the factors, we would like to deep dive into how these factors are constructed on a essential basis, right? So at the start, there are basically 4 or 5 steps. So the first step is creating a universe. So as I mentioned in the earlier example, like these factors would have different interpretation for different investor bases. So the first is to create like to find like a representative set of stocks. So a representative set of stocks can be created by using an existing index, or it could be done by manually curating a list of stocks, or otherwise like from the entire universe of tradable stocks, we can put some filters around trading volume, market cap, around diversification related constraints. Now, once we have a universe of stocks under consideration, then we can go about creating the factor exposures. So suppose if I have to create a value factor, I would look at all the P ratios of all the stocks in the universe, or the price to book value ratio, or the EBIT to enterprise value, which is like the latest trend in the value investing. Or else, like if you want to create a momentum factor, simple concept is to use the last 12 months return minus 1 month return. Um, uh, uh, so while we create these factors or create these exposures, we also want to clean up these exposures. They can be consumed by like the downstream cross-sectional regression models. So we do outlier treatment using mensurization. We do Z scoring so that all the factors come on a common scale. We also do like factor smoothing if there's a lot of noise in the factors. Once we have these factors, we go about creating cross-sectional regression models. So the basic theme around how these models are created is we take all the stocks in the universe on a particular day and regress their returns against like the respective factors which is lagged by 1 day. And as can be seen on the bottom right hand side, this is the regression equation. And essentially we have the exposures which are X, and we are trying to determine like the coefficients from any regression model, which is like the premia. And like any regression model, we also get residuals, which is equivalent to like the idiosyncratic or residual risk in financial management industry. So like there are various ways in which these regression models could be created. Like the way we are showing out here is a cross-sectional model. There's also like the Farmer French way of creating these models where we know like the know like the premium and try to estimate like the exposures of the factor, and vice versa. So why specifically we want to focus on cross-sectional regression models is that these are like holding based, these are more accurate, they adapt well to changes. And earlier these models were quite difficult to construct because of the sheer volume of data. However, with the advent of cloud computing and big data technologies, we can easily scale up these models. Now, once we have the output from like the cross-sectional models, which are generally four, number the covariance matrix of the factors, we have the residuals, we have the premia, we have the exposures. We basically aggregate all of this analysis at the fund level, because this model is built from like the stock level and going up till the fund level. And once we have this model, we do like a model validation to ensure like all the outcomes like covariance matrix, residuals are like robust to like any type of like eventual investor outcome that we are aiming at. Now, coming up to the key theme that we want to focus here is how these factor matter models are helping in terms of fund manager evaluation. So there are multiple themes that come to our mind when we are looking forward to investing in funds. So some of the themes are like, what are the sources of return for this fund, right? Is this like exposure on a particular factor is generally translating to some sort of excess return? So while I take a tilt on a factor and a bet on a factor, is it like also translating to excess risk for me? The other elements that I also want to check is like the manager market timing capability with respect to the factors. And we also want to snowball the funds with various adverse market events like the COVID pandemic and the like the subprime crisis type events. So while these are like the key themes we'll be discussing or focusing on today's webinar, there are other key areas where the factor models have been effectively being leveraged. So the first one is the portfolio optimization. So here we can create various types of portfolios with diverse objective functions. We can do a mean variance optimization. We can do a Black Litterman based optimization. We can build smart beta indices out of it. We can do like ESG driven optimization, or we can do multi-objective optimization, where we want to control both for like the ESG, the returns, and also in some time like control for the risk as well on a 3-dimension scale. We also use it for creating like single and multi-factor portfolios. So some of the techniques are creating long portfolios, long short portfolios using numerical optimization. And recently, like a lot of model portfolios are actively using like machine learning to create strategies which with an objective to either beat the market or to generate excess return over a holding period or to maximize the Sharpe ratio. And then we have like the forecasting capabilities where we want to forecast like the future volatility or higher dimensions of the return distribution. So without much waiting, we'll quickly dive into some real life, real use cases around how the outcomes of these models could be helpful for manager or for fund evaluation. So in this example, we have a fund which is based out of Euro region, and we have an appropriate benchmark. So in this particular visualization, what we are seeing, the blue bars are indicative of the exposures that the fund manager is taking, and the black lines are indicative of the actual exposures on the benchmarks. So in a lot of cases, you are seeing like we are seeing like the funds are having almost equal to or almost sometime less than exposure to the compared to the benchmark on specific factors. But there are also momentum factor which we have like significant positive exposure to. So it could be the case that this momentum exposure is translating to some sort of like excess return or generating alpha. So while we have done this analysis at a point in time, we would also like to see like, is the fund manager consistent in maintaining like the active momentum exposure over a period of time? So this is what the next slide talks about. So in this visualization, what we are seeing is the same fund, but over a period of time. And the blue bars here are now indicative of the active exposures with respect to benchmark over this historical period. And the red line is indicative of the momentum premia, which also tells whether like the momentum is generating a positive return or a negative return over this entire time period. Fortunately, the momentum factor has been mostly positive for this entire period. And the fund manager, as we had seen in the earlier slide, has been maintaining active positive exposure to this factor. So this tilt on the momentum factor seems to be working and would be generating excess return. Now, while we touched about an example where we had only exposure to one factor. But what about like if there are a lot of funds where they have got exposure to multiple factors, so playing by multiple rules? So like these are like some of the popular factors that you see on the screen. So we have the value growth style box, we have the dividend yield, we have momentum, which we discussed, we have the quality factors, we have got the volatility factor, we've got the liquidity and the size factors. So in terms of interpreting this visualization, we see like these cubes which are white in color, they're indicative of the range of the exposures for the particular factors like the style factor, the yield factor, or the historical period. And then like the yellow or sorry, the light blue tubes that you're seeing are indicative of the historical ranges of where the fund manager has been positioning these funds in terms of exposure to the specific factors. The dark blue dots that you're seeing is the actual like exposure of the fund at that point of time, and the black line is indicative of the category exposure. So to take an example of how to interpret is, if I look at the style factor, which is value minus growth factor. So I see like the fund manager has active exposure, positive exposure to the growth factor, and the exposure has been consistent because like the light blue tube has been like doesn't have like a wider range, and this could be translating to some sort of excess return. Similarly, if we look at the yield factor, so the yield factor exposure has also been consistent, and it is like more than like the slightly more than less than sorry the benchmark. And similarly for the quality factor and the size factor. So this is indicative that the fund under consideration is targets growth stocks specifically, which have like low yield and having high quality and small in size. So the fund manager has mostly been consistent with playing around this strategy. However, what we also see is like a huge deviation or a huge scale for the momentum factor and the liquidity factor. So the fund manager is specifically not playing around with these factors, and that is why these ranges keep on varying. But for the other factors, like he has been more or less been consistent. Now, till now, we have talked about like the exposures or the bets or the tilts that the fund manager has taken on these factors. We would also like to see if these tilts have actually translated to some sort of like excess returns. So this is like the return equation, the equation number A7, and it is like the regression equation. So the return of a fund is a function of the factor return and like the idiosyncratic return. Now, if we subtract like the benchmark counterparts from this equation, we get the equation A8, and this talks about like the active return of a fund. Now it is quite mathematical, but we'll quickly go to an example to see how it can be interpreted. So it is the same fund that we saw in the earlier slide. And in terms of the red boxes that you see out here, the gross return or the excess return of this fund is 0.71%. Out of this, like the stock specific return is contributing to 5.63%, and the factor return is contributing to 4.92% in terms of excess return for this holding period. Also, like if you look at the various factors on which the fund manager took bet on, so we saw like in the earlier slide that momentum factor was something he took a bet on. So we also see here that it is actually translating to a excess return of 2.45%. So the tilt has been paying off, and we are getting like return by taking bet on this factor. Now, while we did an like overview or analysis or whether this fund is generating excess return, how about understanding like exposure to that momentum factor is also translating to some sort of excess risk, which I also want to avoid into. So this mathematical equation is quite complicated. However, the gist of this is here that the marginal like risk contribution of each factor is again a function of the covariance matrices and the weighted exposures of the respective funds as shown in equation A10. We'll quickly move to an example of the same fund. So in the red boxes that you see out here, like we again have the attribution where out of the total risk, 94% is coming from factor specific risk. And then we have like idiosyncratic risk, which is contributing to 5.65%. As we can see, also like the momentum factor is contributing to 2.74% return. However, there are other factors also like the size factor which are having slightly more contribution to active risk and risk respectively. So this could be indicative like while we are taking the bet on a momentum factor, it is not leading to maximum amount of risk in the portfolio. And then apart from the style factors or these traditional factors, we also have like sector, region, and currency factors on which we can do similar types of analysis. Now, till now, the major focus has been sources of alpha and whether they translate into returns and risks. The next area where we keenly want to focus is the manager skill evaluation. So again, we are returning to the same equation we saw in the regression slide, but the total return is again a function of my factor specific return and like the idiosyncratic or residual return. Now I can, if I look, this equation is like more relevant at a point in time. If I do this analysis over a period of time, I can convert the first equation into second equation and subtract out the passive factor. So passive factor is basically continuous constant factor to factor exposure to a particular factor over this entire period of consideration. So if we subtract it out, then we have like a factor timing component, which is like a portfolio factor, minus passive factor. We have this passive factor, and then we have the specific factor. In terms of the manager skill sets, what translates into excess return is the factor timing component and the specific component. And then we can define the active ratio, which is like the active returns by total returns. Since again this is quite mathematical, we'll show a quick example of this. So on this slide, what we see here is a particular fund which is based out of Eastern Asia region. And we have the performance of the Eastern Asia region in terms of factor premium, which is like the dark red line. So as you can see, there are major drawdowns in the portfolio for this entire historical duration. And if I see like the dark yellow line, this is like the passive factor that we're talking about. And if I see like the amber line, which is like the exposure that the fund manager has been taking. So sometimes it is below the yellow line, sometimes it is above the yellow line. And we'll explain this, however. So also apart from that, we see this blue line, which is like the factor timing attribution. So just to take an example on how to interpret this. So if we look at the period prior to 2014, there are significant drawdowns in this factor representative of the performance of the Eastern Asian market. And more or less, this factor has been generating negative return. So what has the fund manager essentially done is he has taken like a negative bet on this factor, and that is indicative of the factor exposure being below like the passive factor line. Now, while he has been doing well till 2013, this factor, like the emerging Asia factor, started to bottom out and started generating positive returns in the start of 2014. So what did the fund manager do? He immediately, before this event happened or before the bottom out happened, he started significantly increasing like the tilt on the factor, and that leads to the amber line going above like the yellow line. And the eventual outcome is that we see like a sharp pickup in the factor timing attribution, because due to this positive exposure at a time when the factor was performing positively, we were able to generate positive returns. And then like as we move across the period of time from 2015 to 2020, again we see like the factor hasn't been performing very well, and that is also evident. Like the fund manager has specifically reduced the tail to the factor, and it is mostly like neutral to negative. So essentially, like the factor timing attribution is more or less constant during this period. So if you want to further understand the numerical importance of this factor attribution, we can see like this factor has a attribution of 0.35, out of which the passive attribution is minus 11.02%. The reason why it is negative is, as you can see, for the entire period, the dark red line is significantly generating negative returns. However, due to the factor timing capability, like timing the factor whenever it is underperforming, reducing exposure, and like increasing tilt to the factor when it is performing better, the factor timing has been 11.37, and that is how like the overall standard exposure has been positive. Also, if I look at the overall returns, so the overall returns is 192.7%, out of which like the active contribution is 76%, and the active ratio is 0.395%, which seems good. Now, till now, we have done the like the fund manager skill. Now, another area where we would like to see is how would the portfolio perform if there is an adverse event. So we had one adverse event in 2007 where the prices of oil went from $40 per barrel over a period of next 17 months to $150 per barrel on and peaking out on July 15, 2008. Now, what if a similar scenario happened? And I would like to understand how the fund would have performed given this adverse scenario. And this is not just like one of the scenarios which happened in the last 20 years. So we have just listed out some of like the key events which happened, the major being the COVID pandemic. We have like the subprime crisis, oil price drop, all of these events happening over this period of time. So we can basically create a macroeconomic scenario analysis tool or framework which can understand and help us understand the impact of these macroeconomic factors on my portfolio drawdowns and like returns. So how do we create this macroeconomic scenario analysis? There are three general steps in creating this. The first step is create a macro financial model. So every macro financial scenario could be modeled using some changes in macroeconomic variables. Something like if the inflation is rising, then we see like the interest rate changes in the interest rates, we see changes in GDP. We have two examples here also. Like one is change in the consistently when the oil price was increasing or changing for a period of 5 months. So we have one scenario, or the scenario could be modeled around like when the inflation is increasing and we have both the CPI scale going up and the compensation scale going up. The next step, once we create this financial model, which is a representative of a set of macroeconomic variables, we would like to build a model between like the factors that we, or the factor premia that we estimated, which are representative of the positive and negative returns that we are generating, and our like macroeconomic variables. So we do this using a vector autoregressive model. So why we specifically use a vector autoregressive model is it's obviously like a normal regression model. However, if we try to model y variable, we are also not taking just the x variables, but the lagged counterparts. The key reason for doing that is with a simple example that if Tesla would publish a news around like a new product development, the impact on the stock prices wouldn't be just evident tomorrow or day after, but over a period of time, say like 5 days or 10 days. So essentially that happens with macroeconomic variables also. We try to incorporate the lagged counterparts of these macroeconomic variables while estimating the impact on the factor premium. Now, once we have this model built up, we would then try to create a shock scenario. What is a shock scenario is essentially like we obviously know that we would not have adverse events like COVID pandemic or subprime crisis every now and then. However, we would like to model more like real scenarios where we have like the bond sell-off, or we have like the inflation increasing, and we would like to understand them over a period of time. So like I would like to see the changes happening in the macroeconomic variable over a period of say 6 months, or like over a period of 5 days as an oil price scale. So in the CPI example that is shown on the bottom, so we see that during the period of 6 months, both the CPI scale and the compensation was increasing. And this is how we can integrate all of this together using vector autoregressive model and generate insights. So again, coming up to how do we use it essentially is we have this scenario where the oil price is changing from February 2018 till like June 2018. So initially for the first month, the oil price was at a factor of 1.08, but in the next month it dropped to 1. And immediately following, like in the month of April, it increased by 25 percentage, then 30 percentage, and then to finally a factor of 1.43. And using the scenario, I would like to understand like possibly what is the impact on various assets or portfolios which I have. So we have four like assets under consideration. We have like the energy sector ETF, we have like the utility sector ETF, and we have got the real estate sector ETF, and then a general market, which is like the S&P 500 ETF. So we have defined a shock which lasts for say like 5 months. And if you look at like the first visualization, which is visible here, so this is nothing but the monthly returns as and when we like snowball these assets with these shocks. So in the immediately first month, what we see is when the oil price was 1.28 and in the next month it went down to 1. So the energy sector ETF returns reduced drastically, and it was almost like negative 2%. However, if you see like the other ETFs like the utility sector and real estate sector ETFs, so they are like more or less consistent in returns. They are not as much impacted. However, if the next month when the oil prices increase by 25%, we see a sharp spike in the returns of the energy ETFs, and we see like less returns, comparatively less returns from the other ETFs. And this is how like the entire the four assets which have lasted during the shock period. And after the shock period, since the prices are generally mean reverting, so they are they are tending towards the long-term forecast or their respective means. The visualization also on the most right is like the cumulative return over this period. And as you can see, like this particular period where we induced the shock, so the energy sector ETF has got like the most return, and after that it tended towards its like long-term average. So this scenario, this framework gives us this idea like how would the fund be performing under various adverse market events. And the good thing about this is like while other frameworks like regression would lean like a huge amount of data to run, but the way these scenarios are built up, we can even like pass model portfolios through it, which as we know like have deficiencies in terms of limited returns history or in limited like holdings history or the time since they have incubated. So we can even test model portfolios through this framework. Now, while we have talked a lot about factor models and we discussed on the various use cases around how these factor models can help us in terms of fund manager evaluation, the key theme also which we wanted to focus was how this is like a big data problem. And I mentioned initially like uh, that running these factor models or holding these models have been quite a cumbersome task in the past. So why is this essentially a cumbersome task? If I look at like the growing amount of data assets that we are having currently, so we have this equity data, right? If I have to build a model, say over a period of 20 years, I would be having like close to 40,000 to 50,000 like securities, and with their like their fundamental and market data, it would be a huge chunk of data for the last 20 years. Similarly, if I venture into the fixed income data space, it would be even bigger because the number of securities here could land up into millions of size, millions of counts. And then we have the funds, like there are a lot of funds which are there, and like our current Morningstar universe, we have close to 250,000 odd fund holdings. Apart from that, these were like the traditional data sources, but if I include like the alternative data assets which are coming up, like the ESG data sources or the news sentiment or the NLP based factors from like the corporate filings, it becomes like a humongous task. This data just blows out of proportions. Now, once we have all of this data, we pass it through like the quant engine, which follows all the steps we discussed earlier, basically creating the universe, creating the factors, running the regression models, aggregating all the like the data at the holdings level, and then running all the machine learning operations on top of it to ensure that the data is of good quality. And finally, we have all the investor outcomes, which we discussed earlier. Now, the specific challenges that we had when initially we started to build out such frameworks 4 years back was, and when we were running all of this on on-prem systems, was that there was a sheer volume of data that we had to process. We also had like to run like multiple versions of these models. Like, so if I just look at like the 20 years worth of data and I run like cross-sectional model every day, I'd be running close to like 5,000 regression models. And as I discussed, like there are investors who want multiple flavors of these models. So there would be some investor ask for say like a Eurozone model or for a North America model or for a global model, and then multiple flavors in terms of currency. So some people would want the output in GBP, some would want the output in USD, some would want the output in CHF. Apart from this, like even though like we are still able to run these models, like each of these models would take say around like 4 to 5 hours to run just for 1 day worth of effort. And the major challenge again was like as with any equity data, there is like always the impact of corporate action. So if there's any M&A action or related sorts, we'll have to restate that entire data. So which means like I will have to run all these 50 versions or 50 flavors of these models and 5,000 variants or 5,000 iterations of them over the last 20 years, and I want this output. But how could I get this output to the user in the SLA, say like 1 day or 2 day? since like we have these restatements. So this was really a challenge, and maintaining all these on-prem systems was also quite cost intensive. So we then moved on to the cloud ecosystem. So how the cloud ecosystem help us specifically is they helped us in terms of real-time provisioning. So as I discussed, like we needed like a machine which was very huge. So just to give you an example, like the if I have to run one model, one such model, like a global model, I would need a machine which has 5,000 GB of RAM and 240 CPU cores and 20 terabytes of hard disk. If I'm still able to get such a machine, I will have to bear the cost of hosting this machine for the entire year, even though I'm running these models, say, for once or twice a day. So that's a major challenge in terms of costs. The other thing is like if I want these things to be provisioned on a cloud ecosystem, I can just click a button and AWS or Azure or say Google Cloud would provision such huge machines or fleet of those machines for me in a matter of minutes or so. The next thing also that helps us control a lot of cost is moving to spot instances. So within the cloud ecosystem, all the cloud providers basically have a lot of unused machines which are lying there, and they are willing to like use those machines at a cheaper rate, which in sometimes could be like 60 to 70% if I had gone for say like a dedicated instances. So I could immediately provision or ask any cloud vendor to give me spot instance at the bidding rate I want. Now, while the benefit of having spot instances or spot machines is that they are cost efficient, but what also happens from cloud providers end is like they would take down the instances if they get like a better bid, or like they have a need for a dedicated instance from some other user. So that means like the entire set of machines which I have taken from the cloud provider has to be fault tolerant, right? So that if one of the machines goes down in the fleet of machines which I procured, there are other set of machines which can immediately kick in and start processing all the data. Also, another part is we talked about close to 50 flavors of these models. So we want like 50 such fleets of machines to be provisioned in real time. And that is like a real challenge because based on availability, we might not get them. But due to the availability of concept of availability zones and similar concepts in the cloud ecosystem, we can now get similar fleets of machines across the globe. Apart from that, once we build these models, so specifically the quant engineers are required in building these models. But what happens is like we don't want like them to run these models because we have like DevOps engineers and it is appropriate use of skill set. So the DevOps engineers or the model validation engineers are not that conversant in terms of the methodologies which are going into building these models, and they're just providing like the level 1 and level 2 support for these models. So the entire engine has to be one-click deployment. So it should be just that like the DevOps resource would come up, click a button, and this entire model, this entire infra would be provisioned, entire models would be run, we get the output. And once we have the final output, all of the data is returned to a data lake, which is like a new concept for databases in the cloud on the cloud. So finally, when we have the output, which is available within a span of 6 hours after we use these very compute intensive and cost big machines. So we have all this data written out. We don't want these huge machines to run at that point of time when we are doing the validation, essentially because it is a wastage of cost. So we leverage microservices here for doing all the model validation. So microservices is like an emerging trend in the technology landscape where we just pay for the usage of those services, and those we don't need to provision infra or anything. So for every call we are going to pay for these services. And how it works essentially in some of the cases that we have seen is we have this entire code artifacts which are on-prem, and then with the click of a button we could deploy all of this infra rightly into AWS where such large machines are launched. We use a lot of like big data technologies like Apache Spark, we use Python, we use Hive, Zeppelin, and HDFS. And after this output is ready, like the covariance matrix, the residuals, the holdings aggregation, all of this is written to S3 bucket where they are validated using like AWS Itna on the microservices side. So overall, like the key benefits that we have seen with this is that it brings like immense cost saving for us. So compared to on-prem systems, we are we see that it brings like close to cost savings of 60 to 70%. It is quite like scalable, so we can run 50 or 100 versions of or flavors of these models, and all of the output could be available within a matter of 6 to 8 hours rather than running them sequentially. It is all one-click deployment. It is very fault tolerant. So if the network goes down or something happens, the cloud provider is taking care of all of the things at the back end. So we are least worried about this, and we are more worried, more focused towards generating outcomes which could be relevant for the investment management industry. So while we talked about the factor models, to summarize is we could use factor models for fund manager evaluation. And as we have seen, why this is a big data problem. Now, only having like the factor models for fund manager evaluation is something that we generally don't propose. There are different set of models also, and different set of averages where we need to look into. So rather than looking into risk returns and factor drawdowns, we can also look at manager experience. We can also look at the expense ratios. We can also look at the parentage of the fund, like from which fund house that comes in. What is the architecture of the fund, whether it is active or passively managed. So on that end, like there are some other models which are also built up. So as such, at Morningstar, we have built like quant fund ratings, which are like more forward-looking ratings for the funds and indicative of how the funds would perform over the next few periods. And they're on a rating of 1, 2, 3, 4, 5, going from gold, silver to neutral and negative. Apart from that, some other models that could also help in terms of fund manager evaluation is the fund flows model. So while in our experience, we have also built models that tell us like what drive like flows into a particular fund. So some of the attributes that we have seen is that if the fund is like having low expense ratio, it is like passive based architecture fund, or it is like this is like a small fund has not significantly grown to proportions. So and like the fund manager has got significant experience. So these are like some of the factors which also drive flows into the funds. So holistically, we will have to look at the three models altogether, or like much more new models which are coming up um, as we evolve to make more informed judgments in terms of fund manager evaluation. But today's focus was mostly around like the factor models, and the other two models like are much more intensive and would need like similar sessions to go through in detail. So yeah, that's about it. So we can now open for questions.
Yeah, thank you very much, Sabeeh. So just to recap, we moved from a factor model which many charter holders here and even probably level two, those who have taken the level two exam, they understand a simple factor model, which is
Yeah,
taking a bunch of factors and as independent variables, and a dependent variable as the returns from a fund.
yeah.
And what you've done is that at Morningstar, you have scaled that factor model into repeating it thousands of times using big data technology. Is that right?
Yeah, yeah.
Yeah. So, what is the technological leap here? I mean, bulk of our charter holder members, they are charter holders. So, what should they be doing? They are wealth managers. So, what's the biggest takeaway from for them?
Yeah. So the earlier, the way these models were built was if you had such a custom request, so you would basically go to a company, say like Morningstar, and would place a request that you want to build such a model and for a European region or for a particular market, and then they would be able to run these models for a period of like 3 months, 4 months, as this entire requirement gathering phase, development phase, model validation phase, and then you get the output. However, with the technology leap that we have out here, is everything is like put up in form of configuration files. So the users can come up or the investors can come up, they can specify the configurations. For Morningstar, it's just a matter, or for us, it is just a matter of putting those configurations in the files and then putting it through the engine and pressing a button. And within like 6 to 8 hours, we'll be getting the output. Within a day or two, we'll be able to validate it out, and within 2 or 3 days, we will be getting the entire, we'll be able to share that entire outcome with the users. And the investors could use it for various types of purposes like creating factor portfolios, doing like fund manager evaluation, and the sort of things.
So sorry. So can you walk through very quickly on what the configuration file looks like, or what configuration should a wealth manager give you? What information should she give you to for you to set this process up? And what's the
Yes.
charge?
Yeah. So like the obviously the charge depends upon like the usage or the type of configuration that we are specifying, and it is not so hard and fast. But based on our experience, like the model run could take like around like $10,000 for close to 50 models that we are running currently. And the configuration file parameters are, as I mentioned, like in order to create a model, first of all, we need to define a universe. So for defining universe, like we can specify index. So a configuration could be if I want to use like all the stocks in S&P 500 index or Russell 3000 index for that case. And if I want to specify like manual cuts around trading volume or market cap to define the universe, so the wealth managers can specify that in plain English. And then the next thing is to create those factors, right? So either we have a fleet of factors, right? So right now, like we have more than 50 plus factors, and if you add like the sector and region factors, they are just more than 100 of them. So the users or can pick and choose which factors they want to be part of this engine, and they can even specify their own factors which they want to use in part of the process. And that is all they want to provide. And once we have all of these details, we can just churn out the engine and we get the output right away within a matter of hours.
For instance, Navneet Almira, who's one of our senior charter holders, he's asking what's the proof of concept here, and how do you believe? Because this presumably is a white box tool, right? It's not a black
Yeah.
box
Yeah.
like ARML. If you can also touch quickly on white box versus black box and explain in context, how should people believe in this?
Yeah, sure. So the usage of a white box versus a black box really depends upon a multiple factors. So if I look at the traditional asset managers, they look for more proofs or, as you said, like proof of concepts and explanations, because they have to eventually go to the investors and explain like why you should invest in this particular fund versus Y fund. And they're also not that on the higher end of the technology chain. However, if you look at like the hedge funds, they are like much more adoptive of like the big data and cloud technologies, and they can really churn out all of these factors in a matter of few hours. So that is where like different usage comes in. However, on the hedge fund side, the main focus would be to either maximize the Sharpe ratio or to generate like excess return over a holding period. And specifically the explainability part is not that much important, although like we'd still like to see like how the black box has rated those factors. And right now, like a lot of model portfolios are actually being built using machine learning. Even in India, we have a lot of like model portfolios which are taking specific bets on specific factors when they are overperforming or underperforming. So the other part of white box model validation is we essentially have done like a robust validation of these models. So it is based on like human intervention. So we have like our investment management team who are closer to the markets, who actually create strategies. They have validated the outcomes. If we look at like the popular research journals from AQR or from like popular competitors, we see like the trend of the momentum factor in various markets is quite consistent. If I look at Japan market, we don't see momentum working out. Apart from that, like we do a robust statistical validation of the models as well. So on the statistical validation, we check the R squares of the model, we check like the T stats of the model, we check like the multi-collinearity between the factors, we check condition number. So a lot of like statistical tests also go into defining like the robustness of these white box models.
Right. So, I mean, going back again now, because most of our folks here, I don't know if they can afford $10,000 to
Yeah.
come to Morningstar. But
Yeah.
from an understanding and learning point of view, if a wealth manager wants to do this in a
Yeah.
small way for
Yeah.
his or her own portfolio, what are
Yeah.
the practical steps that she can take to just inform? AMFI website, which is the Association of Mutual Fund
Yeah.
companies here in India. On
Yeah.
its website, we have got daily NAV history for all the schemes that are there in India.
Yeah.
So any practical guidance there?
Yeah, so there are two levels at which we can build these models. We can either build this model ground up, like we can aggregate the holdings of the stocks and then go to the portfolio level, or we can go directly at the portfolio level. So if I were to define this model, say for the Indian market, I would take like all the stocks, for an example, from an SE 500 universe, right? And then I would try to get all the attributes or the fundamental attributes about these companies, right? Specifically, like for value factor, we would be looking at the price to earnings, price to book, EBIT to enterprise value. For momentum, we have like the market data, the 12 months return minus 1 month return. For growth factor, we can look at the like the OPS growth, or like the net profit growth, etc. And we can create these factors. So that is how we can do it at the ground level. And for that, we would need like a data vendor like Bloomberg, or say like Morningstar, who can provide this huge amount of data. And this is intensive to build. However, if you just want to do it at the fund level, right? So we know like from our analysis that there are some drivers or some factors which contribute to return, which is like the fund manager tenor, the AUM of the fund, the expense ratio of the fund house from which this fund is coming into, the historical track record of the fund. So we can use all of these as like X variables, and the Y variable would be like my 1 month ahead return, right? And that is how I can build these models. And this is much easier to build because unlike equities where the data is available at a daily level, or funds would at least like 1 month data, nothing short of that is available. And we can build only like 12 models for each year. So if I even look for 20 years worth of model building, I would just need like 240 regression models to be built up. And that is like a quite easier way of building it out if I just want to do the fund level analysis.
So there's lots of questions. So let me club one question with the doubt that I had in my mind. I recollect one of the Nobel laureates, mentioning that to really understand if the fund manager is having skill and not luck, you will
Yeah,
need at least 70 years of data, which we
yeah,
don't have,
yeah.
right? And so there's a paper in which they've written from a French paper where they've written about skill versus luck.
Yeah.
So how can we be convinced that it is skill, not luck?
Mhm.
And relatedly, Wai Kong, he's I'm sorry, Kai is asking, uh, there is this thing called as uh, what is the criteria we should be using on what exact model to use? There could be 4 factors, there could be 10 factors, there could be 3 factors. So two
Yeah.
questions.
Yeah. So the way these models are built is we have a lot of effort going into like the feature selection phase, which is identifying which factors are relevant in determining like the cross section of returns over a period of time. So for every market, these factors would be very different, right? So if you look at the ESG factor that started quite early in the European market, and now the US market and the other markets are eventually catching up to this ESG factor. So we have a lot of consultation with the fund managers, with like the advisors, the wealth managers, and a lot of like the quant folks in these markets to understand what really works or what really doesn't work. After that, post that we have a set of like say 40 factors out of like 100 factors. We then do a robust statistical check on those factors, like are those factors correlated or not, or are they like distinct drivers of return. We do the financial efficacy evaluation using building long short portfolios, or like using like incorporating them in like existing regression models and seeing like whether it is leading to improved accuracy or not. And after that, once we have these outcomes, or like the covariance matrices, we have got the regression outcomes, we then use it to predict like the volatility of the funds, right? And compare them against the actual values, right? Compare like the manager skill at a point in time, like the example I gave earlier. So we try and test this on say hundreds of funds and see like whether these outputs are making sense or not. And we also have like the investment managers, fund managers reviewing some of these outcomes to see like whether these things are making sense or not. Eventually, we have these parameters around drawdowns, we have parameters around active ratio, we have information ratio, which provide like a very good insight. And looking at the historical data, we can see comparing the actual values and the predicted values, like how these things have been performing and whether the skill was working or not.
Right. So what correct me if I'm wrong. What you're essentially saying is there's no certainty in these predictions. It's based on what is, but from your experience,
Yeah.
these models have performed quite well.
Yeah.
uh, and despite the fact that, as Kenneth C says, that finance data is independent and is not independent and identically distributed. So that itself, could bring in a lot of noise in the models. So ex ante, how many? Now you've been doing this for quite some time, Sabeeh. So what percentage of fund managers consistently beat the market for 5 years, 10 years, 15 years, 20 years? What's the longest that you've seen?
Well, I don't have that metric. Maybe I can get back to that later. So yeah, I don't
No,
have
no,
it.
just yeah. Okay, so you don't have. Okay, fine.
Yeah.
So let me go to other set of questions. A technical question, really, from uh, Asela Gunathila K. The question is, what programming languages we use to process and run these models?
Yeah. So at a base level, we use Python because that is like the golden standard for AI and machine learning these days. And then for big data, we use Spark. On for running these things on the cloud, we use the AWS ecosystem. And on AWS, we do use AWS EC2, AWS EMR, Ethna, microservices like API Gateway, etc. for model validation.
Right. So it seems that for a charter holder member, or but level 2, level 3 person, she may have to learn a bit of Python and then play around and start to assemble her own model to see if that is working. Is that right? I mean,
Yeah.
and yeah.
Yeah, essentially, but I think it is much easier these days. So there are a lot of platforms where we can actually go and create these factors or these factor models and test it out. So earlier we used to have a platform called Quantopian, which got shut down. But however, we have got Quant Connect in India, we have QuantInsti. There are a couple of these like products available which allow us to basically create or backtest these portfolios and create these factor models and test them out.
Right.
So it's not that difficult these days. Yeah.
I see. So is it possible to okay? Uh, Apart from this webinar, are there any online tools? Because it's like, as one of the questioners is saying, at 30,000 feet level, introduction to them. What
Yeah.
else can people do? What are the 3, 4 things people can do to get themselves up the curve?
Yeah. So essentially, as we start here, we need to start getting details about what are the dimensions of market, which basically impact like the cross section of returns. So a couple of resources to refer here is like the book from Grinald and Khan on active portfolio management. And then there is another book from Bali and Turan on the empirical asset pricing, which talks about like the areas on how to go about explaining cross section of returns. And as we move up the ladder, as we get more prone to the financial terminologies around how these models are built or how these things run in the first place or how to interpret them, and we have basic of like some Python language, we can start moving up the curve. On the other end, we can start learning AI and ML technologies, and we can start building like model portfolios out of it. We can, instead of using like a white box model, we can start using like a black box model. And as I mentioned, like some of like the online tools which are available, which actually have all the live data available, and they allow you to experiment creating these factors and testing them in real time.
Yeah, for those who don't know or who have not checked Sabeeh's LinkedIn profile, I think he has taken more than 20 courses on Coursera, Udemy, and he's educated. He's probably a self-educated person, with a passion to learning Python, machine learning, and so on and so forth. Coming back to one more question, Sabeeh, is in your experience, so suppose you had I mean, I don't know how you are investing. We don't have time to cover that, your personal investing subject. But if
Yeah,
you were to, just talk with different sets of people and
yeah,
put your money based on your guts feel, right? And having some sense of returns. How does that compare with your factor model modeling things? Because many of our wealth managers are essentially doing that. They're talking with different fund managers, trying to understand their style, and they're saying, "I'm convinced that this guy is going to give me good returns," and they're putting their money there.
yeah. So the answer could be two-pronged here, right? So as you have been seeing in the US market, it is now becoming almost difficult to beat like the passive funds. and the active funds are only generating like marginal returns, very marginal returns compared to the passive funds. A major reason for that being like while the factors were identified and explored quite in siloed fashion earlier, but now with the advent of cloud computing and AWS technologies, we can just build these factors or test these factors on a fly. So I can use like the RSI factor and mix it with like the momentum factor, or mix it with like the moment, like the value factor, and quickly test it like how this factor works on the NSE 500 universe. So that is when like and then you can backtest it out over a period of time to see like, okay, whether this thing is actually making sense or not for me, or is it like generating return for me. You can do it for other asset classes as well.
Right. So I'm just going to take two more questions. I know we have exceeded time. I mean, Vansh, Jagga, the question is from Vansh is that how can retail investors create positions in factors? A related question is, how do you define the ESG factor? You mentioned that you've been talking with fund manager. If you can give a quick 30 second, 1 minute down, inside, Sabeeh.
Yeah, so I think ESG factor is a big discussion in itself, the way it is created. But essentially, like at Morningstar, we're using data from Sustain Analytics, and we have this ESG risk scores, which are indicative of the actions that the companies are taking to control the reputation risk, to control for the environment, and control for the social and governance aspects of it. So, how good the owners of the organization are also managing those risks effectively is something that is taken into consideration. On the ESG space, we have a lot of other factors also. We have the carbon risk scores, which is available. We have like the controversy scores. We also have like the product involvement scores. And the recent theme is like on the sustainable investing side. Like if there are certain sort of companies like Tesla and the sorts which are actively investing in self-driving cars. So those are the side of top of companies which are driving returns. Similarly, we have in US so some ETFs which are coming up like the ARK ETF, which are like actually investing around these emerging themes. So like robotics or genomic innovation or AI and big data, and they are able to like account for some sort of this excess returns. So for a retail investor, like going about all these factors would be quite like overwhelming in itself. But leveraging like a way of passive investing, or like going through some of the simple research which is available from say like platforms like morningstar.com would be quite helpful. So they can look at the ratings of the fund, the ESG scores of the funds, and they can look at the risk return profile, the volatility, etc., and they can start investing in those funds. In fact, like we have partnered with, I think, Paytm, with where all the Morningstar funds are having their ratings as well, and people can go and provide their risk appetite, check it out, and then a set of funds are recommended, being from aggressive, moderate to various levels, and they can invest accordingly in this fund of funds.
One last quick response, Sabeeh, and advice to our viewers. If you can advise, like people are asking if now they should, our careers becoming more quantitatively oriented
Yeah.
instead of, is that right?
Yeah, so I think more or less, I think these are essential skills which are becoming like quite difficult to live up with. However, like the core financial principles would still be there to stay. Like the still be using like the Sharpe ratio, the information ratios to evaluate the portfolios. The way we create these portfolios would be different, and the rule of the game would be how soon you can come up with generating these insights. And this is where the machine could help you out, and you can supplement that with the human brain. You can't just allow a machine to run haywire and create a havoc, or generate very abnormal returns, or which you can't really explain out. So mix of both is required, but essentially we need to hone the skills over a period of time.
Right. Thank you so much, Sabi. Thank you very much, viewers, for listening in. Please note that we've got a webinar coming up on 6th of May, 5:30 to 6:30 p.m. It will be on career insights on investing in yourself and building your career. It will be taken by Deepak Sone. And the next practitioner series is from Alok Agarwal. It will be on portfolio management on 20th of May. Talk to you soon. Thank you very much for joining in. Do share your feedback and your responses on what topics we should be taking, the speakers we should be considering. Thank you very much.
Yeah, thank you everyone. Have a nice day. Bye.